vTalkInsight, Market Drivers Daily for July 28th, 2026. AI's massive capital build-out is now colliding with funding costs and power constraints, just as oil and chip markets reprice geopolitical and U.S.-China risks. Let's unpack how those forces are reshaping risk and opportunity across the global landscape. AI remains the dominant macro and equity story, but the tone has shifted from unqualified enthusiasm to harder questions about funding, profitability, and crowding. Chip and AI-linked stocks are under pressure, and markets are retesting whether current valuations still make sense given the scale of investment now required to sustain this cycle. Hyperscalers and cloud providers are still ramping AI data center spending, with projections that the largest tech names could push combined capital expenditure toward $800 billion this year, well above earlier expectations. Free cash flow for these firms has been heavily drawn down, so more than 4/5 of upcoming AI infrastructure budgets are expected to rely on external financing rather than internal cash. That reliance on capital markets is already visible. Barclays is deeply involved in large bond programs for hyperscalers, while Meta's $14 billion Texas data center deal sees BlackRock funding about 80% of the campus. New data center bonds are coming with higher required yields than similar issues last year, and concerns over circular financing at names like NVIDIA are pushing up risk premiums on some corporate debt. On the equity side, chip stocks have fallen roughly 20% from June highs. The MSCI World Semiconductor Index is down about 13% this month, and the Philadelphia Semiconductor Benchmark recently dropped more than 5% in a single session. Asian markets have been hit hardest, with Korean and Japanese chipmakers suffering double-digit single-day declines as investors reassess capital expenditure, financing risks, and Chinese competition. Corporate strategies around AI spending are diverging. NVIDIA is locking in as much as $50 billion in Texas data center leases and planning a $5 billion investment into an AI startup, underscoring a very aggressive stance. By contrast, Apple has so far held back from massive AI infrastructure outlays, a more restrained approach that markets have rewarded, helping it overtake NVIDIA in market value. So far, the feared labor market dislocation has not materialized. The wage premium for AI-exposed roles has largely disappeared, bringing pay closer to non-AI jobs, and layoffs are actually rising more in sectors with little AI exposure, such as manufacturing. Companies adopting AI are expanding headcount about a quarter faster than peers, with most of the growth skewed towards senior roles, while internal task reshuffling has lifted job turnover without mass redundancies. The more immediate macro friction is inflationary. High bandwidth memory and specialized components have seen cost surges well into triple digits year on year, and AI data center electricity demand is straining U.S. grids, with PJM warning that some facilities could face involuntary outages. AI Capex also appears relatively insensitive to interest rates because much is financed from cash flows, crowding out other real estate projects and fueling rising anti-AI sentiment, including talk of data center moratoriums in some regions. Against that, there are still powerful structural supports. Cloud providers report payback periods of under 3 years on some AI investments. Non-tech companies are already showing margin gains and earnings beats from AI use, and M&A activity around AI is spreading into European industrials and business services. AI-driven portfolio management is doubling the number of company interactions for some managers, potentially widening the opportunity set even as public AI valuations reset. The next key test will be hyperscaler earnings and Capex guidance, which will help determine whether today's correction marks a healthy consolidation or the start of a deeper regime shift. Turning to geopolitics and energy, the picture today is one of softer prices layered on top of unresolved supply risks. After flirting with triple digits late last week, Brent has slipped back into the 80s and even below $87 at times, helped by a pause in U.S. and Iranian attacks and diplomatic efforts around key shipping lanes. Beneath that surface calm, the physical system is still stressed. Shipping through the Strait of Hormuz has been heavily disrupted for months, with reports that traffic is largely paralyzed despite talks between Iran, Oman, and the United States about reopening routes. Middle Eastern oil exports are estimated to be down more than 40%, yet crude prices have not spiked in line with that loss, suggesting markets may be underpricing the tail risk of a renewed blockade or accident. Buffers are thin. Strategic petroleum reserves globally, including in the United States, sit at their lowest levels since the early 1980s, reducing the world's ability to smooth future shocks. U.S. output around 14 million barrels a day has helped cap prices, but that support is not guaranteed, given ongoing debates over regulation and possible windfall taxes that could alter the investment trajectory. On the ground, instability is bleeding into corporate earnings. Middle East and Africa revenues are down nearly 5% for large multinationals. Hilton has reported close to a 30% revenue hit in the region, and luxury names such as LVMH are seeing almost flat growth in fashion as conflict dampens spending by wealthy shoppers. Royal Caribbean flagged that geopolitical worries are beginning to weigh on cruise bookings, while the Gulf's reputation as a safe business hub is being questioned as attacks on energy infrastructure and data centers persist. Energy is increasingly seen as the main macro risk channel. Rising fuel bills are crowding out other household spending. Weekly credit card data point to slower consumption growth despite higher gas prices, and earlier 40% moves in crude over just 2 weeks reignited debate about stagflation. Central banks are reacting cautiously, signaling that yield curve moves will stay highly data dependent, with oil volatility and weather-driven price swings now as important as traditional labor indicators. Forward-looking, scenario ranges are wide. As long as major routes, such as Hormuz and the Red Sea, remain at risk or partially closed, many see an $80 to $100 oil range as plausible, with associated support for energy earnings and continued pressure on inflation-sensitive assets. If diplomacy genuinely reopens those choke points, some estimates suggest crude could retrace toward $50, which would relieve headline inflation but challenge parts of the energy complex. That two-way risk feeds directly into asset allocation decisions and sets the stage for how U.S.-China tensions will play out in trade and technology. The final driver today is the evolving U.S.-China relationship, where strategic rivalry is increasingly visible in market pricing, especially across semiconductors. Reports that Chinese state-backed firms are pushing into advanced chip-making equipment and domestic lithography have rattled confidence in the durability of Western dominance and are feeding a broader reassessment of earnings power. High profit margins in the chip industry have attracted new entrants, and both established players in China are adding capacity, raising the risk that gross margins and even revenues could come under pressure over the next few years. Concern is particularly acute around ASML's franchise, as the emergence of a Chinese deep ultraviolet lithography machine, even if still technologically behind, signals a clear intent to reduce reliance on foreign technology. Markets have moved quickly to price that in. The MSCI World Semiconductor Index is down about 13% this month. Chip stocks have dropped around 20% since June peaks, and Asian names such as Samsung, SK Hynix, and Japanese peers have seen some of their steepest declines in over a year. European tech, including ASML, is under pressure, and Nasdaq futures remain fragile as investors question whether concentrated AI and chip exposures still warrant premium valuations. Policy dynamics add another layer. Beijing has warned that further U.S. tariff increases would cross a red line and has capped new duties while signaling potential retaliation, including around AI firms, ahead of an upcoming leaders' meeting. Washington is simultaneously promoting U.S. leadership in artificial intelligence, and Germany is openly analyzing Chinese economic weaknesses to gain leverage, all of which points toward ongoing deglobalization and supply chain rewiring rather than a quick reset. Corporate case studies highlight the transmission channels. Mercedes and other European carmakers face weaker Chinese demand and intensifying competition from Chinese electric vehicles, even as cost-cutting can still support short-term share price moves. SK Hynix expects record earnings, yet trades well below its highs, and a potential 200 aircraft order for Boeing from China remains pending. The next watch points are any policy surprises from the U.S.-China meeting, fresh headlines on Chinese chip equipment capabilities, and how chipmakers frame China-related risks in upcoming guidance, all of which will feed back into global tech multiples. To wrap up, AI is still the key structural growth engine, but today's price action makes clear that funding costs, power constraints, and policy risk now sit alongside innovation as core drivers of returns. Energy markets look calmer on the surface, Yet thin buffers and unresolved choke points keep two-way risks in play, while the U.S., China tech and trade rivalry is moving from headlines into semiconductor earnings expectations and equity valuations. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.